now turning our focus to the economic front, we're joined by Ettienne Le Roux. He's the chief economist at RMB, and he's going to be giving us analysis of today's repo rate increase by the Reserve Bank. This, of course, of 25 basis points. We're also joined by Viv Govender. He's a senior analyst at Luhumo Capital, bringing his voice to the interest rate conversation as well as dissecting the markets for us in a short while. Gentlemen, welcome. Ettienne, let's just start off with the key considerations that the governor and his team had to bring to play for them to reach 25 basis points.
Sure. Let me just first start that by saying that we didn't expect this today. We thought it will happen in January, but obviously that was not the case. So what led to this decision? I think a couple of things. The central bank was very explicit regarding the fact that inflation risks to their projection have deteriorated dramatically, and we have to thank a couple of things as far as that is concerned. Number one, the drought, the potential impact on food. Secondly, Eskom, and then clearly a risk that tariffs may go up by more than the 12% that they're currently building into their model. And then persistent rand weakness. It's one thing to have the rand weakening over a 3 or 6 months period, but now we've been in a weakening trend for 2 or 3 years. So clearly the central bank is worried that at some stage pass-through from weaker currency into inflation is become more pronounced. And then lastly, quite surprising to me is that the central bank today's statement was very explicit about their thinking around the Fed.
Right.
Today they said that it's very likely that the Fed will move in December. They've never been as clear on that as today. And then also later on in the statement, the central bank suggests that in the lead up to or in the aftermath of the Fed hiking in December, the rand is likely to overshoot from current levels. That's quite explicit. And I think it's a combination of those factors that led to today's move.
Viv? As you said, I mean, the Fed hikes as we expect in December, I mean, unless something remarkable happens in between now and then. Because there is going to be a bit more volatility. Is there not going to be an incentive for the SARB to come in again and hike to basically show up the currency should it weaken in the wake of the Fed hike?
Well, I think that's the environment we're in. So if the currency behaves itself after the Fed, then don't expect much movement. If indeed the currency sells off dramatically, sharply after the Fed hike, then a January hike is very, very much on the cards early next year, another 25 basis points, currency depending.
But considering that, I mean, then shouldn't they have actually held off? I mean, the argument would be, because the last time they hiked, in anticipation of the Fed hiking rather soon, the Fed held off for longer than most anticipated. And now that we're basically hiking again in anticipation of the Fed hiking. And when the Fed hikes, you're going to have to hike again. So aren't we possibly going to have, you know, the market moves relatively. It's not just an absolute number that they're looking at. So they're looking at a trend in terms of the rate hike or the rate moves. And therefore, we may have an absolute trend that may be higher than it needed to be because we hiked before the Fed hiked.
Those are valid concerns. I think the central bank is of the opinion that let's hike earlier, then they perhaps might not have to hike more later. It's a gamble that they're taking, and time will tell if it
That's
works.
been a theme throughout, even when Jill Marcus was the governor. We don't want to be behind the curve. And of course, the curve hasn't been a curve for such a long time. It's just been flat.
Exactly.
There's been no curve.
No, exactly right. So, which then obviously makes the Fed move the first time in 9 years or something, a big event, and a crucial factor to think about when you think about policy movements in SA. I mean, that's true.
Just a quick one on what this all means for the South African consumer, given the economic pressures that we already have been feeling on the consumer, and now this rate hike, and the expectation of what might happen in December. What is the future for the consumer looking like?
Well, for the consumer and the economy at large, I mean, the central bank is taking the view that despite today's hike, real interest rates are still very, very low. Monetary policy is still accommodative, only less so. In other words, we don't have to have sleepless nights over the economic impact of today's interest rate hike or those that we have seen so far. I think the central bank suggests that, you know, it can take 1 or maybe 2 decimal points off economic growth. It's certainly not a train smash. The fact of the matter is that we are in a weak economic environment. The growth is low. The economy is flat on its back. You shave another 1 or 2 decimal points off economic growth, you're just generally in an environment where the economy next year will barely grow, somewhere between 1 and 1.5%. The SARB today shaved a few points off their forecast for growth next year as well. So, and one of the key reasons why the economy is weak is because the consumer is taking strain. And we know there are many reasons why that is the case.
Yeah, it's a kind of vicious circle, and I think the market passed judgment with the retail shares today. They were saying, well, the consumer's been resilient despite predictions, and maybe it's now time when that slow spending does happen.
Yeah, I mean, this is at a time when consumers are not borrowing as it is, or very reluctant to borrow, at a time when their income is under pressure, we know that. And sure, sad if food inflation were to go to close to double digits, or perhaps even double digits, into double digits early next year or middle next year, a further squeeze on the consumer, not good news.
Just as we wrap up this conversation, I think the local government elections are looming in 2016. Is that going to create some sort of politicking around how the Reserve Bank might act, understanding that independence is supposed to be there? But do you think that this is something we should be thinking about?
Will there be pressure?
Okay, well, that's a good question. So one may criticize the central bank from a growth perspective, or criticize their hike today from a growth perspective, but from a sovereign rating perspective, today is not necessarily bad news, because it suggests that the central bank is independent, they're not being influenced by political decisions, or unlikely to be influenced. From a sovereign rating point of view, it is not a bad outcome.